Jaime, thanks indeed for talking to us. So, a couple of things that we need to talk about, but I want to touch on U.S. interest rates because we had the Open Market Committee releasing their minutes of their decision, and it looks embedded in that minutes a lot of uncertainty on the outlook, something that you indeed would say you expected. But what do you make of the direction of interest rates in the U.S. now?
You know what? I think it's we're coming to that point where whatever the Fed or central banks do won't matter. And that's to me, the big story. All along, I've been saying I like gold because I'm a bond bear. Interest rates, right? Well, the 30-year bond just crossed 5% in the U.S. That to me is a big question. 4.50 for the 10-year bond. Borrowing rates for mortgages are going through the roof in the U.S., going to get more expensive. I don't think rates are going to stop going higher because we are really, go back to that chart I sent you a while ago about currencies. We live in a fiat system where money is backed only by the word of politicians to pay us back. That's what people are wondering. Well, is Trump going to pay me back the 10-year or 30-year bond? Right. So we're having an exit of money from the bond markets. But that's also a loss of trust. The other problem is there's way too much debt. You know, we look at the U.S., 37 trillion, 36 trillion. The numbers don't really matter anymore, but that's only for federal, then at the state. Then look at Japan, look at the world. That's why interest rates are rising globally. Now, that's the big bottle half full, bottle half empty. It's bad for pension plans. It's bad for insurers, but it's great for gold. Gold is money. All else is credit. You know, we go back to that. The big thing is that look at Japan, right? Look at the news that came out of Japan that insurers had big losses over the quarter because of losses to their bond positions, right? Well, look at then what's happening in China, where the Chinese government is encouraging insurers and financial institutions to buy physical gold. So they get it, that gold is money, right? So it's the offset to debt.
I want to just go back to what you said a little earlier when we spoke about interest rates. At what point does the debt in America get so heightened that interest rates just have to be cut?
I don't think it matters that the Fed cuts rate because they're going to have to cut. They're going to have to cut because they're going to have to monetize the debt. The Chinese, the Japanese, nobody's buying U.S. debt. They're not even buying their own debt. So what the inevitable outcome of this? It's the inevitable outcome of all credit bubbles bursting that the buyer of last resort is going to be the central bank, right? So they're going to have to cut to also print money to start buying their own debt, which is already happening. You know, the TIC report showed that now the U.S. government owns 30% of all the debt. Now they have to roll over $9 trillion in that environment, right? So we're talking about a lot of money. One of the problems that people don't understand what a trillion is, right? A trillion, you know what it is money that won't be paid back in one generation. And that's the important outcome.
That's an interesting way to see it.
That's why the only way forward is a devaluation of that debt, which is kind of what Besant is saying and Judy Shelton and a lot of they're being the responsible ones and really telling us what really has to happen, but people are not really listening because why? Because the stock market's still at 42,000. So that's where the generalists, all these guys that are parking assets. Oh, don't worry about it. The stock markets always hold their value. Well, really, when the bulk, like global stock markets are worth 90 trillion tops, maybe around that amount. Well, total debt, we're talking about quadrillions. So the stock market is inconsequential in relation with the amount of liabilities that are there, of which pensioners are dependent on it. Governments are dependent on it.
And that's another interesting angle. Let me ask you, what do you think about one other piece of news coming out of the U.S., Elon Musk now relinquishing his title completely? Where does that leave the storyline?
Well, I think he's a smart enough guy to figure out all of a sudden, wait a minute, I'm saving billions here and there. But that's a drop in the bucket when interest rate expense alone is rising at $1 trillion a clip, right? And the higher interest rates go, the bigger that gets. So in essence, it's like using a bucket to try to save the Titanic. So to me, I've always said the monetary Titanic, the true lifeboat is gold because that's what really will float as money, right? But it's being overwhelmed by interest rate expense and the total interest because all of this debt has to be rolled over, but the money isn't there.
What about short-term movements? I mean, I see gold prices rising somewhat, and then before that, after that weakening that we saw because of the weakened dollar, So, I mean, do you place much emphasis on these slight little moves that
No,
happen?
no. Actually, to me, you know what? It's funny because I don't worry about price. I worry about allocation. That's what I keep saying to people. Right now, the allocation in the precious metal sector, in the monetary metals by institutions in Western institutions is 1%.
Yeah.
Every time we've gone through these periods, it's had as high as 30%. So that's a clear indication that even institutional pensions are not worrying about how to save themselves from what's coming. Canadian pension plans have been parking their money in U.S. dollars, where those are also devaluing in U.S. dollar assets. Now they want to put this tax on, which kind of creates a different problem. Meanwhile, here in Canada, we have some amazing gold mining companies that I think eventually these silly neophytes, I would say, I don't know how to call them, but call themselves pension managers. But sooner or later, they're going to see, hey, at least I'm getting a dividend that's going to continue to grow, and that's a good place to park some money instead of just cash, because cash is losing purchasing power. Right? This is no different than what happened in Chile. What always happens through all these credit unwindings, and that's why. I don't know. I've been talking about a monetary shift for a long time, but it was all because debts eventually were going to become unpayable. And I think we're there. I think yields are 5% on the 30-year bond. They've come down again. They were 4.97 as I walked into this meeting. But I think that's a clear indication of where they're going. And that will only accelerate.
Yeah. Well, that's telling signs. Let me ask you, so the Bank of America projecting gold could hit 4,000. Silver, $40 by early 2026, I mean, due to this instability. I mean, what's your take? You mentioned silver earlier. What's your take on silver?
You know what? Again, the whatever target the banks are giving me, I never listen to them. My take on silver is the fact that the gold-silver ratio is set by nature, right? Smart people, when people finally start to get it and they realize, wait a minute, I got to park some of my money in gold or something, they're going to realize Canadians, for $4,500, you can buy 1 ounce of gold or at 45 or 100 ounces of silver. So what's the better choice? I'd rather buy silver, right? And so what happens is a substitution effect. It happens with butter and margarine. You know, the economists love to talk about that, but they never talk about the substitution effect of gold and silver. That's why silver always follows, right? So I personally think that what we have here is a big discount. Yesterday, as I posted about Elon Musk, I said, and don't forget, gold is money. Everything else is credit, and silver, which you're going to need a lot of, is still pretty cheap, right? So I think that's what's important, is that silver has that dual component, which everybody's neglecting right now. But when the price of gold gets to 4,500, 5,000, 55, at one point do people figure out, wait a minute, I better own some, but this is too expensive. But hey, I have this choice. And that's why silver and then the producers of both gold and silver follow. And I think on this run up that, because right now, you know, you're talking about the short-term fluctuations, which are more important to me, having followed the gold market back to 2006, I started talking about it. It's holding. It's not coming back. Everybody was saying, oh, we're going to go back down to 2,400. Well, here we are still sitting at 3,300 and $33 silver. But what's more important, the HUI is strengthening. So we're starting to see that shift of smart money choosing the right place to go.
I mean, as we wrap up here, I mean, if I have to ask you, what do we do in terms of allocation? That seems to be the most important question.
Exactly.
Why is that?
Okay. Latin American experience. You need at least 20% to protect your wealth. I always say minimum 30% for all my clients, because that extra 10% is to really benefit and try to not. So what you want to have is have an allocation big enough so that you're protecting the purchasing power loss of your portfolio, but you want to have a 10% so that you can be selling and buying that Enbridge or those pipelines that are coming down, which dividends are building, while maintaining your allocation. So 30% at the very least, and then from there the speculation starts.
Jaime Carrasco, thanks very much indeed for coming in.
Always a pleasure.